Good afternoon and welcome to my end of the week recap here for the S&P 500. I have futures up here on my chart right now. This is the W pattern I was looking at from May. Target has been officially hit and crushed thanks to the unemployment numbers and jobs report that came out Friday. Now, whether or not you stand on the side that the numbers are accurate or they're overestimated, whatever. There's always a margin of error for those kinds of things, and it is what it is. So you can't take what is said, and you can't take what is reported to be estimates. There's somewhere in the middle is the truth. So even though it was expected 19% unemployment and they reported 13, there's the asterisk for margin of error, which in reality could be about 16%. Now that's still a huge beat in my opinion, as opposed to the estimate of 19%, in addition to the number of jobs that were open, or I wouldn't even call it recreated, but the jobs that were open, people started getting paid again because the economy started opening back up. As I've been saying for the past 2.5, 3 months, this whole COVID nonsense was going to be one, maybe a 2-quarter impact, and the market started to price that in, I would say, down here at the lows of March. Once they started to realize that the numbers we were seeing were just completely asinine and blown way out of proportion. And obviously buyers started putting their money to work. So you see this huge rebound. I don't even know the percentage from where we've come to where we are now. 48% here from the low of March, and we'll call it just over 2 months, 2.5 months roughly. The market has priced it in. Those participants that put their big money to work have the funds available to get real data and to create financial models based on that data, not just what the news is saying, not just on what Fox News or CNN or MSNBC or whoever you follow. The news is virtually not, I'm not going to say wrong, but they're always late. They're always behind the story, and they're always trying to sell a story. They're not trying to provide real information. And the sad thing about this reality is fear sells more than anything else. So with that said, here we are now within, I think it was about 6% of all-time highs, if I remember correctly, from the high of Friday, 5.5%. So we're just off of all-time highs by about 20 bucks on the S&P 500, the SPY, 200 points on futures here. So I would say that I was probably pretty close to being correct on the fact that this would only be a couple of quarter impact and we would be back at all-time highs. Now, it's tough to say that can happen within X amount of time frame, but here we are. So without too much more of a tangent, my target has been hit, and I'm going to go over the sectors here for the S&P 500. Okay, Q's technology came down, and as I said, also came down to investable levels. I was proven right. Sadly, I did not have Q calls. I had SPY leaps, which I actually did start to reduce some on Friday. I reduced some of my 350s and 400s for next year. It's a very, very nice trade. Has more than made my year, and we'll see what happens going forward. So first of all here, technology, as I said, broke out of all-time highs. Excuse me, good elevated volume. Should be a confirmed breakout, but we'll see what happens with it going forward. Maybe it gets a little bit of a pullback here. Over to XLV. This is the healthcare ETF. This is also something within striking distance of all-time highs. We're about $2 off of all-time highs. And with the developments in COVID, vaccinations and treatments and whatnot, that's probably going to help to elevate this ETF. And I also put the percentage, the weighting percentage here in the S&P 500. So the Qs is 20, call it 26%. XLV is almost 15%. Then next up is financials. Now I've had to reorder some of these because financials have made such a massive run up. I also was able to sell some of my 2022 leaps here for XLF on Friday. Started buying down here in the 18 and 19 range. Very nice hold. Extremely happy with the move so far. Looks like it can continue up higher. I do see a potential move up here to around 28. However, there's this one line here that I thought I had on this chart, but we'll put it here anyway. So these two levels here is where price action actually broke down from. So I want to see price action hold above those levels. If it comes down into it in the daily time frame, I'll watch for the 30 and the hour to put in some sort of a rounding bottom and start to put in support at those levels, and I will rebuy some of those leaps because Banks do still look good. They're not at what I would call investable levels by fundamental analysis, but they are at least in an area, or at least in a price pattern that would imply trend following traders to be buying them. So next up here is the communications ETF. This one also is about $2 off of all-time highs. You see 57.75. We closed at 55.51. Another very nice mover there, strong V. I would expect these moves, these ETFs that have made this kind of a move, to have some sort of a pullback. You know, it doesn't have to happen, but I would expect it to do so at some point. If it all happens at once, then that's going to pull obviously the whole ETF of the S&P 500 down. But we'll get to that if that does happen. Next up here, I have XLY. This is consumer discretionary, which is heavily weighted with Amazon. And one quick note on Amazon, Jeff Bezos came out about, I'll call it 10 days ago now, and said basically the value that you receive for paying for Prime far exceeds what you're actually paying for your Prime membership. So what that translates to me is they're going to increase Prime membership rates probably in the very near future, maybe by their next earnings call, or maybe on their next earnings call. Who knows? But that is going to be a huge addition to their bottom line, and that's probably going to continue to push XLY up higher. Again, this is something else that's less than $2 off of all-time highs, and it's probably going to press that here this week. So next up, we have the industrials ETF. Even industrials are catching a bid here. You can see they're within 11 points of all-time highs. This makes up about 8% of the overall S&P 500. Has reclaimed this massive breakdown level that was from 2019. So as long as it holds above this 72-ish area, should be good to go. XLP is consumer staples. Looks like it could be a potentially nice breakout. I saw a lot of banks make this exact same pattern here, and what I mean by that is you essentially have this initial run up, you run into a level that was already pre-existing from a prior point, put in a higher low, and now you're right back at that level. So if this gets a move up here into, say, the open of this week, I'll be looking for some staple names that do move well and that are very liquid for a move up here until staples actually reach around this level. So XLP is looking very nice for potential breakout as well. That's also going to help the US market. And then over here onto XLU, this utilities. It's kind of hard to get excited about utilities being in this pattern simply because it's usually a defensive sector. So as the market's starting to look weak, that's when money goes into utilities. But as you can see, it's doing the same exact thing as XLP, this consumer staple. So this is also set up for a very nice breakout. Maybe it starts to make a run back up there. And if all these sectors start working together and pressing just like technology, just like healthcare, financials, and communication sector, the S&P 500 is going to be at all-time highs very, very soon. So next up here, I do have, this is XLE, the energy ETF, mostly oil names. One of the lagging, or I should say the most lagging industry here. I don't have much faith in XLE, as I said in my last couple of videos. Oil is a very small percentage of the market, and it's a dying industry, so I can't get too excited about it. I did manage to sell out some of my USO leaps on Friday as well. Still in a little bit of oil, just because once it broke down way down here, it was at least worth buying some. So next on here is XLRE. This is the real estate ETF. I've actually moved some of these lines around, put them back over here. This was the bull flag I was looking at a couple weeks ago when I did my last video. Very nice breakout. I did not manage to buy any REITs. I do have my list of favorites that I do go to. I was just busy with a lot of other names, but REITs do look very nice. And if they can get over this 2019 breakdown of 37, call it 37.35, $38 roughly, probably going to start pressing towards all-time highs, just like every other sector. XME, this is the materials ETF. Again, another weak sector, maybe because we get our materials from outside of the U.S. It's been outsourced, whatever. It's another small portion of the S&P 500. As you can see, it's 2.6% of the overall U.S. Market as far as S&P 500. The one saving grace is a potential double bottom. Now, there's a little bit of a higher low, so it's not a perfect double bottom, but if it starts to break above, excuse me, this 27 level in the next couple of weeks, I would think it can make a move back up to 30 because that would reclaim that 2019 breakdown. Just something to think about there. Onto transports, because if you've watched my past videos, you know that I'm a huge proponent of Dow theory. So as transports go, so goes the market. And transports, led by the airlines, have made a very, very nice move. This is one chart that I actually do want to go down to the daily time frame though. Gapped above the 200 SMA, which is this purple line, and actually closed slightly below it. Now, that brings me to an interesting point about airlines. Now, does the recent developments in airlines where the CEOs come out and say we're going to reduce the number of tickets, we're not going to sell the middle seats, they're going to remain open, we're reducing our flights, we're reducing our hubs, does that lead me to believe that airlines are now in the clear? I mean, airlines operate on such a razor thin margin anyways. They're reducing the number of, or they're reducing the amount of potential revenue they can receive for even a full, quote unquote full flight. That doesn't seem very encouraging to me. So a little hesitant to say that transports are going to continue higher, although they did not only reclaim the 200 SMA, but this 2019 breakdown. It's tough to really get behind the airlines, or excuse me, transportation because of the airlines move. A lot remains to be seen. I think it was more of just a massive short squeeze, and we'll see. One thing I do want to point out is Buffett he was almost dead wrong. I mean, you can't be any more wrong than that. It happens to everybody as traders, as investors. Sometimes you do end up selling low. Who knows? Maybe he was selling naked puts so he could get put some shares. It's tough to say what he was actually doing, but he sold almost the dead lows of the airlines he got out of. He sold almost the dead low of some of the banks he was getting out of. So this just goes to show that you don't always have to follow somebody who is historically known as a great investor in order to create some alpha, because even they can be wrong from time to time, and it's very obvious right now. So anyways, want to touch on the SPY. Now that I've gone over the futures market and the sectors, the yearly candle here for the SPY, everybody should already know, is an outside bar. That means it's taken out the range of last year. We are back up to levels where I was saying the end of last year, stocks were expensive. Industries, sectors, everything is stretched PEs. It's happening again. Maybe we're at a level where we're going to see some profit taking. It's tough to be a significant buyer at these levels, is my point. So with that in mind, now that I've taken some of my leaps off, I will be looking to take more swing trades off of the 8 and 21 EMAs, these blue and yellow lines, for a move to reclaim the open of the year. One more thing to draw on here is this level here is, I believe it was 230. The open of the year was 323.54. So if we get a reclaim of this opening price, that is going to potentially make it look like this. And we'll just move this down here. It's going to be a very huge bullish green hammer. Now, at highs, generally this can be argued as a potential bearish reversal pattern, even if it does close green for the year, and it's only June. We still have 6 more months. So what is the likelihood that we actually continue to press even higher and higher this year? I don't see a lot of catalysts to do so, unless a lot of companies start to bring their businesses back from overseas, which was the ultimate goal of Trump in the first place, and it has started to happen. I think that's why there's been a boom in the economy, and that's why a lot of the economists have actually come out and said, you know, we're going to see the strongest rebound we've ever seen in history, and obviously that is taking place. One more thing to note on my daily time frame here. We're about to see this yellow line cross through this purple line. This is the 21 EMA is about to cross through the 200 SMA. Back to 1993, this has happened 21 times. Of those 21 times, 13 have actually been much higher. The price action has been much higher within the next 30 days, as opposed to 8 that actually did not. So just a little small statistic to use going forward. That is just about, well, I guess 60% of the occurrences have actually been bullish. That does not mean I'm going to straight up start buying on Monday. I want to see a pullback. Now, that's 30 days into the future, we see prices above 320, 321-ish. So if I get a pullback to the 8 EMA, My goal is to go ahead and buy some 325 calls for August or some 325 calls for September because I want to have plenty of time. There is a chance that price action does come all the way back down here and test and bounce off the 200 SMA. It's a very extended. The RSI, if you're a believer in overbought status, is overbought now, technically being over 70. However, if you go back and look at every time that it's happened, even in the near future, or excuse me, the recent future, recent history, excuse me, you had a nice explosion here, you had an explosion here, you had nothing but a strong uptrend here. So overbought does not necessarily mean to go out and just load up on puts. So be careful if you do want to short the market or sell calls or buy puts or however you want to do it. Just be careful and keep those things in mind. My next target on a pullback is going to be this 330-ish area. Don't know how long it'll take to get up there. I think the market will be in for a shock in the next round of quarterly reports, and maybe it's kind of overshot some estimates on that front, and we do get a pullback into that, which I believe they start coming out in July for financials. So that's it. So we'll see what happens going into next week. If you have any questions or comments, please feel free to leave them down below. Hope you're enjoying the rest of your weekend, and good luck next